Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at Draganfly.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. We're looking at the fundamentals of Draganfly, which, operates in that fast-moving unmanned aerial systems market.
The UAS market, yeah.
And when we look at the core data, there's a really clear bullish signal here. It looks like the company is hitting a pretty significant inflection point.
An inflection point?
Yeah, we're seeing accelerating top-line momentum, especially across 2025.
And I think that phrase, accelerating momentum, is exactly where we need to dig in because the numbers themselves tell a really clear story.
They do.
If you look at the quarters for 2025, Q2 revenue, it climbed to over $2.1 million?
$2.115 million, yeah. Which is a 22.1% increase year over year.
Which is good, but it's the rate of that growth that really catches your eye.
Exactly. It's not just steady, it's expanding.
Yeah.
And that's, the classic sign of a company that's getting real traction.
Okay, but here's the critical detail, and I think you'll agree, it's not just the total revenue.
No, not at all. It's the quality of that revenue. The makeup of it is what's changing the whole narrative here.
Let's unpack that then, the structural shift.
Yep.
Because there's this massive divergence between total revenue growth and product sales growth.
Huge divergence.
In Q2, total revenue grows 22.1%. Fine. But product sales, we're talking actual drones, the core hardware surged an incredible 37.1%.
Right. And that gap is everything. That 37% surge is structurally superior growth. It suggests a pivot away from, say, lower margin services and towards selling their core high margin systems. This product-led path is the key catalyst for gross margin expansion down the road. They're selling scalable assets.
And we saw that strength carry right into the third quarter.
We did. Q3 product sales were, $1.6 million out of a $2.155 million total?
Exactly. And what's fascinating here is that this success is specifically in unmanned systems that are compliant with the National Defense Authorization Act, the NDAA.
Right. And focusing on NDAA compliance isn't just a technical thing, it's a strategic move, a very smart one.
How so?
It narrows their customer base toward the highest value contracts you can get. Military, defense, border security, all places where that compliance is absolutely mandatory.
Speaking of high value, it looks like analysts are finally responding to this turnaround.
They are. The revenue forecasts for 2025 are projected at, $6.62 million?
Yeah, which is a massive jump. It's about a 41.66% increase from the prior year's estimate.
And that flows down the line. You see the expected EPS, the earnings per share, improving pretty dramatically. It's projected to go from a loss of over $3 to a loss of just $1.
So still not profitable, but the trajectory is pointing in the right direction.
Exactly. It signals they're scaling up, and these high-margin defense and product orders are actually starting to move the needle.
Okay, so a 41% growth forecast is great, but let's be honest. The drone market is crowded. What's their actual competitive advantage? What's the moat here?
The moat, like you mentioned, it pretty much boils down to regulatory capture. It's that NDAA compliant status for their UAS.
And explain for our listeners why that's so powerful. Why does that create a moat?
Well, it's powerful because the NDAA acts as a gatekeeper. It explicitly locks out non-compliant rivals.
So we're talking about the big Chinese drone makers.
Chiefly, yes. It locks them out of these incredibly lucrative U.S. and allied defense contracts. So by having this compliance, Draganfly protects its market share in these high-value niches, no matter how cheap the competition gets.
That defense angle is a game changer for sure. But it seems like they're also pushing hard into commercial infrastructure.
Oh, yeah.
I thought the details on the exclusive manufacturing partnership with Valkyrie for drone delivery stations were really compelling.
That's a very forward-looking play. The initial order, about $400,000, it positions them as a critical infrastructure partner in this emerging autonomous delivery world.
So they're not just selling the drones.
Exactly. They're building the ground infrastructure, the landing pads, charging stations, the logistics hubs that drones need to operate at scale. That exclusivity could create a very defensible revenue stream.
And then you have the humanitarian catalyst. This is the one that has, I think, huge PR potential, the Autonome partnership.
Yeah, that's high-impact stuff. They're integrating their tech with Autonome for landmine detection and route planning.
In post-conflict regions.
In post-conflict regions, yeah. The pilot deployments are expected later in 2025. This is a mission-critical use case that goes way beyond just surveillance.
And if it works.
If those pilots succeed, It opens up a massive market expansion into defense and humanitarian applications globally. You
Yeah.
could be talking huge contracts and, incredible visibility.
That humanitarian angle also ties into their global relevance. I saw mentions of recent defense collaborations in the Asia-Pacific region.
With big players, too, Babcock International and SITEC.
Right?
And that just confirms their compliance advantage isn't just a U.S. thing, it's global. It shows their UAS are essential for allied nations looking to upgrade their security infrastructure.
What I found interesting, too, is how they're using their balance sheet to lock in these customers, like providing vendor financing of $150,000 to a partner called ILS.
That's a sign of a really strategic management team. Offering financing like that shows a lot of confidence in your own product, and it helps you lock in those long-term relationships. It's not just a one-off sale.
So the growth is there, the moat seems strong, partnerships are high impact, but, we have to look at the other side, the balance sheet and the core risks.
Of course. So on the financial side, we start with a big positive. The company just executed a strategic capital raise, nearly $25 million in 2025.
But a raise that big usually means dilution for shareholders. Why is this seen as a net positive right now?
Because it completely removes that near-term financing risk. For a company in this kind of high growth phase, having $25 million in cash gives you the runway for R&D, for scaling up production.
Okay, that makes sense.
And on top of that, their balance sheet is incredibly clean. The debt-to-equity ratio is 0. That gives them a ton of stability and flexibility.
All right, now for the elephant in the room, the bear case. They're not profitable. That $25 million could just be fuel for a bigger fire.
Absolutely. The main bear case is all about the lack of profitability and the valuation. We can't ignore the reality of Q3, a comprehensive loss of $5.4 million.
Which gives them a negative net profit margin of what, over 240%?
243.25% to be exact. They are burning cash very, very quickly to get this growth.
And that cash burn leads straight to the valuation concern, the price-to-sales ratio. What's the PS telling us?
Well, it's highly elevated. We're talking 32.7x.
And for anyone listening, that means investors are paying over $32 for every single dollar of sales the company makes today.
Which is just, it's massively above the industry average. It's an extreme bet on future success.
A premium like that demands flawless execution, which brings us to the execution risk on these big programs.
Precisely. The speculative upside from that autonomous landmine detection project. It's tied entirely to the success of that pilot.
And these are not easy places to operate.
Not at all. We're talking post-conflict regions, logistical hurdles, regulatory hurdles, safety hurdles. If that pilot fails or even just gets bogged down,
that whole market expansion just evaporates.
It evaporates, and the speculative upside in the stock goes with it.
And with these big deals, Valkyrie, Autonom, ILS, doesn't that also mean a lot of customer concentration risk?
It does. While the product sales are diversifying, the big revenue streams still depend on a handful of these massive strategic partnerships. If any one of them slows down or ends, it could create significant headwinds.
So for listeners who want to go deeper after our conversation, what data gaps should they look to fill from the actual financial filings?
2 main things. First, look for a clear picture of free cash flow, how much cash is actually cycling through the business. Second, you want to know what the insiders and big institutions are doing.
Form 4s and 13Fs.
Exactly. Form 4s for insider buys, 13Fs for institutional ownership. That gives you a real read on market confidence beyond just analyst reports.
Okay, let's shift to the technical setup. The market has definitely been rewarding this narrative.
It absolutely has. The stock is up, 70.8% over the last year. That's a significant outperformance against the rest of the industry. So the technicals are confirming the fundamental story.
And what specific signals are confirming this accumulation trend?
You're seeing the classic bullish patterns, higher highs, higher lows. That suggests consistent buying, especially above that key psychological support level around $8.
And the moving averages?
The long-term moving average, the EMA 200, is way down at 2.98. The price is well above it, confirming a very powerful long-term uptrend is in place.
And sentiment seems to be lining up too. Are the shorts getting squeezed?
The data suggests that, short interest fell recently, about 4.4%. So bears are backing off a bit. Overall sentiment is generally bullish, driven by that new Asia-Pacific news and the Q3 product growth.
So what are the key calendar catalysts? What should we be watching for over the next, say, 3 to 6 months?
The biggest one, without a doubt, is the autonomous pilot results. They're expected in Q4 of 2025. That's the proof of concept moment.
A success there could unlock massive contracts.
Massive contracts, yeah. We also have the ongoing revenue from the Valkyrie order and, of course, the next earnings report to see if that product sales growth is sustainable.
So what's the horizon here? Is this a quick swing trade on the news, or is it a multi-year hold?
You know, it's interesting. The setup kind of supports both. It's a great swing trade if those pilot results hit and you get a quick re-rating.
But long term?
But long term, if these defense and autonomous delivery verticals really scale up and they cement their position as a critical infrastructure player because of that NDAA mode, this could easily be a multi-year hold.
So what this all means for you, the listener, is that Draganfly is clearly in a product-led high-growth phase. It's fueled by that critical military compliance and these big strategic partnerships, and that $25 million raise gives them the runway to execute.
However, you have to see that huge 32.7x PS valuation as a kind of contract. It demands flawless execution on these ambitious, frankly speculative pilot programs. The company's entire future valuation depends on them proving these large mission-critical use cases work.
The big question you have to ask is, can management handle the intense logistical challenges of these global contracts while also scaling up production? That's the bet you're making here.
It's a complex, fascinating story.
It is. Thanks for tuning in to Smart Wealth with Joshua. Keep a close eye on those upcoming pilot results. And don't forget to subscribe and leave a comment to stay ahead of the market catalysts.